why don't we talk a little bit about interest rates then? Because I think I've been wrong. I said the Fed wouldn't raise the last 2 times, and they didn't listen to me. They continued to raise interest rates. It's all their fault. But we're seeing good numbers on inflation, and we're starting to see the market actually price in that we would have 100 basis, maybe even 200 basis rate cut by the middle to third quarter of next year, which I think is very optimistic from a market standpoint. You want to talk about that?
Yeah, very optimistic. So we plotted here 3 lines. The black dotted line is the Fed forecast, and that's from 2 meetings ago. So this meeting where they came out and continued pausing rates was not a projection meeting. They released their projections every other meeting. So we didn't get anything new from their forecast. Then the November 13 pricing is just what the market was pricing in on Monday before CPI, and then 14th was, once we saw that low CPI number, which we'll talk about in a second, repricing down expectations for rates in the future. And what you're saying is, we look at where a rate's going to be at the end of next year, market's expecting about 100 basis points of cuts, which is pretty significant. While the Fed's saying, those 2 increases that you didn't think were going to happen, they're saying we'll pull those back. They probably didn't need to raise those extra 2 rates, like you said, and their forecasts are to just pull back a couple of those rate increases next year. So really the question is, if that doesn't happen, the market has priced in a lot of cuts. There's a lot of time to reprice this, but could that mean a decrease in equity prices as they try to reprice in that the Fed's forecast might actually be accurate?
Well, I mean, certainly if they were to raise beyond expectations, we'd see a drop, but I don't think that's bad. We were talking about it before, where if we can maintain these interest rates long term, that's actually going to make a more productive economy. You're going to have a lot less consumption, a lot more investment. You're going to have people placing those into the bonds to get higher yields. So if we can tolerate that as an economy, we don't go into recession, that actually would be strong. And what happens is you get that initial drop because of the repricing, but now the growth rate that you're discounting at is a faster slope so that you would rally out of it. I'm not advocating what they're going to do, but it wouldn't be the end of the world. We would just see probably another speed bump in this process.